Every startup success story you've heard of, from Google to Uber to OpenAI, has one thing in common. They all took venture capital money. But what the hell is venture capital? And why do VCs seem to have all the power? I'm Evelina, and this is Everything Startups, where I break down the startup and venture capital world, making it easy and accessible. Today, we're diving deep into venture capital, what it is, how it works, and where it all started. So, let's go. Let's start with the basics. First of all, what is venture capital? In a nutshell, it is money invested in early stage companies with high growth potential. It is companies that VCs or venture capitalists are betting on that they think can return 10x, 100x, or even 1,000x their investment. We're talking about turning a $1 million investment into 100 million or more. Venture capital is actually a pretty recent invention. The first modern VC firm, American Research and Development Corporation, was founded in 1946. Before that, if you had a business idea, you either funded it yourself or you found a wealthy patron. The VC model that we know today really only took off in the 1970s and 80s, especially on the famous Sand Hill Road in Silicon Valley. That's where VC firm legends, which by the way we will cover in another video, like Kleiner Perkins and Sequoia Capital, got their start. Now, where do VCs get the millions of dollars that they are investing? Well, they don't invest their own money. They're the middlemen. They raise money from what is called limited partners, or LPs for short. These are pension funds, university endowments, wealthy individuals, and institutions with serious cash. The VCs themselves are called general partners, or GPs. They convince LPs to give them hundreds of millions of dollars to invest in startups. And in exchange, they charge two types of fees. The first one is called a management fee, which is usually 2% of the fund size every year. So on a $100 million fund, that's $2 million annually just for operating expenses. The second one is called carried interest, typically 20% of any profits. So if they turn that $100 million into $300 million, they have $40 million of the $200 million profit. This is why VCs are incentivized to swing for the fences. They need massive wins to generate returns that justify those fees. A startup that grows steadily and sells for 3x, that's not exciting enough. They need unicorns, companies worth over 1 billion. Now, let's take a look at the timeline of a fund. And by the way, VCs raise funds every few years. Now, a typical VC fund has a 10-year lifespan. And understanding this timeline explains so much about how VCs behave and why. Years 1 to 3 is the investment period. This is where VCs are actively looking for new deals and writing checks. Then from years 4 to 7 is what's called the management period. They're working with portfolio companies, doing follow-on investments, and trying to help companies grow. Years 8 to 10 are typically the harvest period. This is when it's time to cash out through IPOs or acquisitions. This timeline creates urgency. VCs can't just sit on investments forever. They need to return that money to the LPs within that 10-year window, or things are not looking good for the next round or the next fund. And here's a crucial point. Most VC funds follow the power law. Typically, 1 or 2 investments out of 100 or so will generate 80% of the fund's returns. The rest might break even or lose money entirely. This is why VCs are obsessed with finding the next Facebook or Google. Now, not all VC firms are created equal. There are basically 4 categories. The first one is the mega funds. These are the Sequoias, the Andreessen Horowitz, the Kleiner Perkins of the world. They manage billions of dollars and write checks from 10 million all the way to 100 million. These are the firms everyone wants money from. Then there's the more traditional VCs, solid, established firms managing somewhere between $100 to $500 million funds. They're the workhorses of the industry. And then there's the micro VCs, smaller funds, which are oftentimes also managed by solo GPs, usually under $50 million. They write smaller checks, but can move faster and take bigger risks on very early companies. And then there's also corporate VCs. Think like Google Ventures or Intel Capital. These are investment arms of big corporations looking for strategic advantages and not just financial returns. So each type behaves differently. Mega funds need massive outcomes and typically won't look at you unless you're already generating serious revenue. Micro VCs might bet on you with just an idea and a strong team. So this brings us to, what do VCs actually want? Despite what they might say in their marketing materials, it all comes down to these 4 things. Firstly, a massive market opportunity. They need to believe your market could be worth tens of billions of dollars. A $100 million market isn't big enough. There's not enough room for a unicorn in that. They are looking at billion-dollar markets. Second of all, an exceptional team. VCs bet on people more than ideas, despite what you might think. They want founders who've done it before, or at least have domain expertise and the ability to execute and show why they're the perfect fit for that business. Thirdly, a differentiated product or business model. You need something that's genuinely better, faster, or cheaper, and defensible against the competition. And the fourth one is proof of traction, especially in 2025. VCs want to see evidence that your product works and people actually want it. Revenue, user growth, key partnerships, something concrete. But here's the reality check. Even if you have all 4 as a founder, most VCs will still say no. The average VC looks at 1,000 deals per year and invests in maybe 10 to 20. So the odds are pretty brutal. But don't worry, we'll cover the nitty-gritty of fundraising in another video, so stay tuned. Now, for the part VCs don't advertise, taking venture capital changes your company forever, and not always in good ways. First, you're giving up control. VCs typically want board seats and significant say in major decisions. They might push you to grow faster than you're comfortable with, or pivot when you don't want to. Secondly, you're on the venture timeline. VCs are going to pressure you because they need big exits within that 7 to 10 years timeline. This means you can't build a nice, profitable lifestyle business. You're either going big or you're going home. Now, thirdly, the pressure is immense. As I mentioned, VC-backed companies have a 90% failure rate. Most startups that take VC money either fail completely or return less money than investors put in. And the next one is that dilution is real. Every funding round means you own less and less of your company. Founders who take multiple VC rounds, which is often the case, often end up owning single-digit percentages of companies they started and put so much hard work in. So here's something founders don't realize. Once you take VC money, it's almost impossible to go back to bootstrapping. You're locked into the venture path. But the good news is that venture capital isn't the only game in town. There's many other ways to fund your business. There's angel investors, and then there's revenue-based financing companies, there's crowdfunding platforms, and even things like government grants and accelerators. And of course, bootstrapping, which means growing your own revenue and putting your own money in. And there's many good examples of big companies that did that, like MailChimp or Basecamp. And they did it all without taking a dime of VC money. It really all depends on what your business model is and whether you really need the VC money. So there you have it. VC money isn't inherently good or bad. It's just one option. The question is whether it aligns with your goals, your timeline, and your vision for your company. If you're building something that could genuinely become $1 billion business and you want to move fast, VC might be right for you. if you want to build a profitable and sustainable business on your own terms, you might want to consider alternatives. So, what questions do you have about venture capital? Drop them in the comments below. And next week, we're breaking down how to actually pitch VCs in 2025 and onwards, because the game has changed a lot since AI has come into the picture. Hit the subscribe button and ring the notification bell to find out in the next video. See you then.